riding the market down and back up is one thing, but riding the market down and then adding capital at a low point, you come back much quicker. And so that has become an integral part of the portfolio on the alternative side.
Welcome to Decision Points. I'm Doug Hudson.
I'm Scott Wood.
Man, if you're joining us online, watching us, or listening, thank you for choosing and making time. You're in for a treat. We welcome Chris Pate. What's happening?
Happy to be here. Thank you.
Yeah. Where are you from?
Originally, Alpine, Texas.
Alpine?
West of the Pecos.
Hence the boots.
Yeah, sure. I'm not really much of a cowboy, but I do wear the boots occasionally.
Were you born in Alpine?
Born in Alpine.
Born in Alpine, okay.
And was there till I was in middle school.
Okay.
But see, true cowboys, he knows you don't disrespect a true cowboy by acting like you're a cowboy when you're really not. So I respect that.
That's right. I've known a few of them, real cowboys.
100%. So you know when you're not. Let me give you, as you're watching or listening, a little introduction to Chris. Chris, you're our managing director of True North Fort Worth. You graduated cum laude from Texas Wesleyan. You serve on True North's management committee and voting member of the investment policy committee. You spent 11 years with Q Investments, $2.5 billion Fort Worth multi-strategy hedge fund, founded in 1994. Your tenure there included risk, trading, restructuring initiatives, and eventually overseeing equities trading and financing operations for the firm. Really, with your outstanding leadership and your broad experience in traditional and alternative investments in both public and private markets, you've always focused on the smartest ways to compound capital for our clients. That's a heck of a introduction. Glad you're here.
Thank you.
Okay. You were raised in Alpine. Where you finished high school? Did you do everything there?
No, moved in middle school to Fort Worth, change of pace. And
mom, dad job? What led y'all there?
Yeah, my dad practiced medicine in Alpine for 20 years and his dad for 50 before that. And they worked some together. I think they felt like a change of scenery for my brother and I would potentially be good. He was younger. Okay. I think they had one too many friends with kids who were out there getting in trouble. And in the 1980s in Texas, you know, there wasn't a whole lot to do in Alpine. And so people could come up with creative ways to get in trouble. And honestly, it was great. I love having grown up out there. It's a special place in the world. We own some land out that way now and have for the last 20 years. And it's one of my favorite places, but being able to grow up there and then move to a lake, you know, as a teenager and do high school and all that on the lake with watercraft and skiing and all that were two very different, you know, kind of places to be. And so I feel like I got the best of all worlds.
Yeah, you went from riding horses to a jet ski or wake surfing.
That's right.
You guys are related. Who's better at water sports?
Oh, I think Scott's better at water sports nowadays. He gets a lot more practice than I do.
I was going to say that too.
Well, you're pretty dang good. What kind of medicine did your dad practice?
Family practice, delivered a lot of babies.
Yeah, interesting.
And he still practices. He's in at John Peter Smith Hospital in Fort Worth, and he's 80 and he keeps threatening to go part-time, and he has for about 10 years, so we don't know when that's actually going to happen.
That's phenomenal. So, he's got to be a legend in Fort Worth.
He's the second oldest doctor at JPS. There's another guy up there, Dr. Kumar, who's 86, and
wow. They're fighting each other to see who's gonna.
So I think he's got a ways to go.
Yeah, hopefully. He's not gonna let Kumar win.
No.
He's got. Isn't that so cool? I've known several family doctors, but back in the day, they delivered babies. No family doctor is delivering babies today. I mean, that's all specialized.
Right. Yeah, he delivered.
When's the last time
thousands.
he delivered a baby? Yeah, you know the last time he delivered a baby?
I think he had been in. There were some things that have happened in Fort Worth that he's been involved in, but it was 1990 when we left, and that was it for the private practice.
It's interesting through these conversations, Chris, we've had with lots of folks on Decision Points. Much of why we named it were these critical times in our life where we'll make a decision that will have lasting impact, some positive, some negative. and be as specific and frankly as vulnerable as you're willing to be. What's a core memory? Maybe positive, maybe negative. Growing up in Alpine, maybe it was the move to Fort Worth. What's something that really helped shape who you are today as a child or a young, maybe a teenager?
I mean, I think growing up out there, the thing that I remember most is being able to run around town with friends on bikes and nobody have a care in the world about safety or any of that. So it was a pretty special time to grow up. I mean, I'm a child of the 80s, I guess. I was born in 77. So my memories in Alpine were all in the 1980s. And that was a pretty fun time to grow up, I think. And the seminal moment would be, I just happened to be one of these people that met their wife at a very young age. And so we got to know each other. She came to our school freshman year of high school and sat next to each other. Name? Jennifer. Yep. Sat next to each other sophomore year of high school all year. And last day of school, it's kind of embarrassing to me, but you said be vulnerable. Last day of school, she gave me her phone number because I guess she was tired of me not having already called, and I was like, this is great. I'm in. She's gonna answer now. She gave me the number, and so we had our first date summer after sophomore year. June. So
sophomore year, she's kind of crushing on you. And
no, I liked her. I liked her, but I was a little shy at that time.
You weren't ready to quite ask for the sale, so to speak.
Right.
Yes.
She's like, I got to close this.
Yeah, she's like, it's about to be summer.
Come on, right.
I'm not going to see you for
Waited
3
all
months.
year. Yeah.
That's right.
Did y'all start dating then?
So we did, yeah. June 8th, that right after school got out, 1994 was first date. And
oh, dude, if you remember the date, which is impressive. Mm-hmm. Do you remember your and Alicia's first date?
I do, actually.
Okay, go.
September 25th, 1994.
Are you kidding me? You remember the date?
Yeah.
So we got you beat. I'm 3 months ahead of you.
There you go.
What did you and Jennifer do on June 8th?
Well, we actually went to a movie and then went out on the lake.
All right. What movie?
Maverick, Jodie Foster and Mel Gibson.
Incredible. What did you and Alicia do?
The museum, the DMA was opening the Hammond building. It's like their new expansion, and it was a black tie deal, and I needed a date, and so I asked Alicia
She was a heck of a date.
Yeah, I asked Alicia to go to that with me, and the rest is history.
So, in true confessions and a full disclosure, if Carrie, my wife, was sitting here, we went to dinner. I don't remember the date. I'm so sorry. I'm not as good as you guys are in that category. But what she does remember, you probably remember this. It was an Italian restaurant on Beltline, and we went after Metro, this Bible study that I was a part of. And all she really remembers is me taking gum out of my mouth and putting it on the plate like I was going to chew it afterwards. And she will die that I'm telling this story that she still married me, that I was
even
that
after
uncouth, that I was that uncouth. It started her rehabilitation program on me.
That's right.
So you finished high school in Fort Worth, and then where do you go?
Went to school in Fort Worth at Texas Wesleyan. Went there to play baseball and be pre-med, following the family footsteps. I have dad and granddad, obviously, who are physicians, but also a number of uncles. And as it turns out, the next generation down, my generation, were generally not cut out to be doctors. So we have one, my younger brother, who's a retina surgeon. All the rest of us are finance and lawyers and that kind of stuff.
Where'd you kind of come under the conclusion that you weren't going to practice medicine?
Middle sophomore year of college. Yeah. And there wasn't one specific thing, but I just generally started to dislike organic chemistry more and more. And by the time I was finishing organic 2, I thought, if medicine's anything like this is just it's not for me. Yeah. And by that time I was already not playing baseball. And so, started school to do 2 things in one direction, and somehow don't really remember specifically why, but thought finance sounded really interesting, and moved over to finance, and so then graduated 4 years later with a finance degree, no more baseball, and then have done that ever since. It's been great.
When you were making that shift, had you taken a finance class at that point? Or
no.
You just were like, that's kind of interesting, and so I'm going to go check it out?
I think I was basically looking at the business school majors and thinking what sounds the most technical or the most interesting. And I'm naturally a pretty good numbers person, and so it made sense versus marketing or something like that.
So at school, do they teach you that it's finance and not finance?
Yeah, I know, because we just said it differently.
Which one is it?
If you're from Alpine, it's finance.
I think
100%.
I think I'm known to say it both ways, maybe depending on the crowd. I don't have a strong.
All right, so it's a little bit like a social drinker. You figure out where you are, and then finance, or it's finance.
Yeah,
I like it. Contextualized to the audience.
That's right.
When did you and Jennifer get married?
We skipped college graduation and got married right then. So that was May 27th, 2000. This is when we graduated, or when we got married, and both of us started work right after that.
Yeah. What does she do?
She taught.
Okay.
And then started having kids and has not taught anymore. Now she teaches for free.
Now she teaches for free and works for free.
Right.
Full time. Tell us about the kiddos.
We've got a 19, an 18, and a 16. Sophomore in college. Our daughter, Lola, she's a nursing major there. And then we've got a senior in high school and a sophomore in high school.
You think, obviously, Lola is your daughter? Mm-hmm. She's in nursing school, so she's drawn to the medical profession. Do you think any of the boys will go that way or not?
Highly doubtful. No, they're it appears to be businessy kind of path for the two of them.
All right, so you graduate. Tell us about your first career, kind of first job. What's that look like?
I had a series of internships that got increasingly closer to where I ended up being. I mean, I knew that, nothing against Texas Wesleyan, but Goldman Sachs wasn't going to be out there recruiting. And so I knew early on that I needed to do some additional work in order to find a good job. And so sophomore year of college, I ended up with an internship at a law firm in downtown Fort Worth. I called all of the trustee members at Texas Wesleyan that were attorneys and asked them if they would interview, and they got a few interviews and then picked one. And
he's getting over his call reticence at this time. Calling every trustee at this point. I'm impressed.
Right. No, I did what I had to do, but figured out pretty quickly I didn't want to practice law. Yep. And then my junior year, I got an internship at Prudential Securities. Great guy that hired me, and the problem with that was I had this preconceived notion that as a finance major, I was going to get to pick stocks, and it was going to be like a lot of analysis and more of the movie, Wall Street, not the cold calling part, but the Gordon Gekko stuff. 100%. And then I realized at Prudential, it was the cold calling stuff. And that led me to kind of look around and figure out, well, what else could I do? Is there some type of analysis type role that I could get with a finance degree? And I got an internship interview with Q Investments fall of my senior year of college. It was a hedge fund. In 1999, nobody knew what a hedge fund was unless you worked at a hedge fund, and it was just not a common term like it is today. And so met with these guys, a bunch of smart people. The founder had originally worked for the Bass family in Fort Worth, which is how a lot of hedge fund and private equity groups in DFW got their start.
Yep.
And I got an internship and thought it was great. And then they gave me a full-time offer, and it was a no-brainer.
What are some of the highlights and lowlights, good, bad, and ugly, of that first 8 to 10 years of your career?
Highlights: incredibly smart group that I was working with, learned a ton, always had more to do than I could possibly do. And I felt like it was a great training ground. What was interesting about it is that we didn't buy stocks. And so, from my perspective today, it's just a different background, having spent 11 years at a firm that did anything other than buying stocks to make money. Whereas, today in our business, we have a lot of exposure in equities and always will, but it was a very opportunistic firm. And when I started, it was largely arbitrage type strategies, which were traditional real hedge fund kind of strategies at the time. Convertible arbitrage, merger arbitrage. I started in full-time summer of 2000. By the end of 2000, there was a distress cycle that was bubbling up, and then that became more acute in 2001 with September 11th and then 2002. And so we did a lot of distressed debt purchasing during that time. We started an aviation leasing portfolio in 2002, which was basically buying airplanes post September 11th when that market was really distressed and leasing them out to different airlines. And so it was a pretty creative, very opportunistic firm. At that time, we were probably managing $1 billion in assets, which was good size for a hedge fund back then, but not huge.
Yep.
The founder had and has a great reputation as being an amazing investor, and so I got to learn a ton over the years there. So
what'd you learn not to do in those early years?
Being able to learn risk and reward, and when to bet big and when not to, and how to think about downside. Q was largely a credit-focused fund, and so credit investing, unlike equity investing, is more about what is your risk. You're typically capped on your upside. You're buying a fixed income type instrument, and so it's kind of like the old saying, picking up pennies in front of a train. So you don't want to get hit by the train. And so that mindset of learning about what is the downside in this investment, I think is probably one of the things that's been the most helpful for me, decades now later in my career, is always having that kind of downside first mentality. Even though we're not always talking about credit investments.
That's good.
And Chris, I've heard you say before, Q was sort of, I've heard you describe it this way, they did anything other than buy stocks and bonds, which maybe comment on that and how that's influenced how you think about markets and allocating capital today.
Well, I think even back then, there was a lot of opportunity outside of the traditional equity market. The famous investors when I was in college or coming out of college were the Peter Lynch's of the world, who ran Fidelity Magellan Fund, and now you look out there, you've got Warren Buffett, who was and is still really well known, but now I think the private equity guys and the hedge fund guys are a lot more well known, even than the public market. I'm not sure how many public market, equity stock picker mutual fund portfolio managers I could name today.
Yeah, why is that? Why is that cyclical? Why are they more known or in vogue than the mutual fund?
I think, probably multiple things, but one of them certainly is the fact that the private assets as a percentage of overall investable assets in our economy is much higher than it was back then. The number of, and I don't have the statistics in front of me, but the number of public companies in the United States is way less, than it was 30 years ago. Private equity as an asset class is way, way larger than it was. Venture capital, way larger. Real estate, private equity, way larger, et cetera. So there's been a big shift. And I think that's, my background has going back to your question, I guess has probably been beneficial in that sense, because it's now acknowledged in 2023 that there are a lot of ways to make money outside just the public markets. But back when I started working, that was more of a niche, type of a deal. Private credit or underwriting direct loans to companies. That was the purview of banks. Nobody else did that. Well, today there's a million private equity funds that completely have circumvented, the banking system.
That entire process.
Right.
The other dynamic that you have with the public market mutual fund business is that now indexes are everywhere. And, back in the day, Fidelity would have an index fund, or Vanguard might have an index fund, but it was one of a menu. Now indexing is pervasive. And so, a lot of these smart managers who might have been managing an actively managed public mutual fund
Yep.
have moved to the private equity space or these other places because indexing now is taken up. I don't know what the percentage is, but it's huge relative to where it was 25 years ago. Chris, let's talk about your transition from Q to Western and kind of, you know, how that was precipitated.
Sure. So I had never looked for a job in 11 years. I was very content at Q. I had never heard of this little firm called Western. Don Woodard called me in December of 2010, and they were looking to fill a seat and find someone to run the asset management business for Western. Western had an M&A advisory business, which still exists today, so a boutique investment bank, and a small registered investment advisor that managed a little over $100 million, and call it, 10 families made up the bulk of it, and then some employee money, and then friends and family type money. And they had a series of less than successful people in the seat who were managing that business. And Western's M&A business, the model was help Joe entrepreneurs sell his company and then talk to them about managing the assets after that. So it's a good model. What they needed, and Don figured this out, is they needed someone to build an investment platform. And what they had prior was more retail brokerage sales type background individuals, and I had never sold anything at Q, and so I wouldn't probably have been real comfortable going into a position where I needed to immediately go like build a business through sales. But what I did feel comfortable with was that I could build an investment platform, and hopefully if you build it, they will come. And so that's really what the basis of it was, and it was the perfect fit. And I started in February of 2011. We, over the next few months, tried to figure out what is the best structure. I knew that our clients needed to have access to private or alternative type investments. I was, of course, very familiar with the hedge fund space. I thought, with a lot of confidence that I could put together a portfolio of hedge funds that could be reasonably successful, and eventually do the same thing with other private assets as well. But what's the best structure for that? And we had, this is again, I think maybe a credit to the training that I had at Q. The mindset was always, we're not going to know everything off of the top of our heads, but if you don't know something, we'll just find who the best expert is, and then utilize that knowledge, and then do that. And so, among others, we talked with Aiken Gump, who we still use here in Dallas. Jim Deacon is our partner that handles all of our securities law stuff, and got good advice from Elliot and Jim at Aiken Gump about what the right structure would be, which was a multi-series limited partnership that we set up back in 2011. And that is Western Alternative Strategies LP, which we now refer to as WAS, and is today the platform for alternative investments for True North.
So then True North comes into the picture with Western. Talk a little bit about that.
So summer of 2015, if you remember, oil prices had fallen out of bed that fall, and OPEC had changed production, and it was Thanksgiving weekend of 2014. Oil prices start to crash, and by spring, summer of 2015, there was some real distress in the energy space. We were looking at a co-investment with a Fort Worth-based sponsor on the energy side, and somehow got wind of the fact that True North had been looking at the same deal. We had this commingled vehicle. It was easy for us to put our clients in, to the tune of a few $100,000 each, and then aggregate, a larger investment amount, and then make the minimum. This particular fund had a multi-million-dollar minimum, and we started talking with True North, and it was clear that they were interested in doing the investment for their clients as well. And so we just said, well, hey, you can put some of your clients in our vehicle and get the same exposure, and that's how we worked it out. And so that was June of 15 when we closed that. That was the first official, partnership that we had with True North. And it wasn't that long after that Scott and Mark and I started talking more seriously about, hey, what does this look like if we put these two companies together? And that was a little, it was slow. We took our time and measured twice or 4 times in this case maybe, and then eventually cut once. And so Jan 1 of 19 is when we ultimately did it, but it was in 2015 that the conversation really got started.
Yeah, and I don't think I realized that there was 4 years of dating, doing other investments maybe together during those years.
Call it 3 years until we made the decision, let's get this thing done. And yeah, that's right.
And what's interesting is, so, at True North, we had a history of doing private investments, probably dating back to 06, 05, 06, 07, somewhere in that time frame. We started allocating capital to private investments. Initially we partnered with a large family office that had a kind of a fund-to-fund structure with both public and private investments in the structure, and it was sort of a single investment that was very diversified on the back end with multiple line items. And then as time went on, we'd run across a real estate deal, or we'd run across an oil and gas deal with Western, but everything was sort of one-off, one deal at a time. Everything had to be papered every time, multiple conversations with clients every time. Like, we did it the wrong way. And the guys at Western, had really set it up from with the idea to scale it from the beginning. And so as, we started investing with these guys, it became apparent they had something that was really valuable from from an infrastructure perspective as it related to this whole private investment conversation.
100%. And you're building trust, which typically trust has to take some time and a few reps between. Are the people trustworthy? Do they deliver? Do they overpromise, underdeliver? That trust is building, and obviously it came together in 2019. Where does it go from there?
So, I think largely my day-to-day job is fairly similar to what it was.
Is it?
At Western. I spend the majority of my time on the investment side. I spend some time with existing client relationships. I spend some time developing new client relationships. And then probably the only thing that's real new and different on the True North side versus Western is it's just a larger firm. And so there's some firm management responsibility that I have as well, but that's not a huge amount of the day-to-day. So it's pretty similar. It was one of those, everybody talks about a 1 + 1 is 3 kind of a scenario, but in real life, that's actually pretty hard to come by. And True North really did need a scalable alternative investment platform. On the Western side, we were not doing a lot of sophisticated financial planning and didn't have the capability to do anywhere near what True North did. And there was also a scalability problem. I was getting I would say pretty close to what the end game would be for my capacity, and we had a 3-person team effectively. So there was either going to have to be people hired on the investment side, which would take me away from that, or there were going to have to be people hired on the client advisory side, which would take me away from that. And it was a no-brainer to say, well, let's plug Western in with True North, and then we've got immediate scalability in all of those areas. And so it was an actual 1 + 1 is 3. We had 0 client turnover from the Western client base to True North. So I think that's a proof in the pudding testament, but overall, I think our, clients have gotten better service and a better overall offering, not just on the investment side, but on the planning side as well. And everybody's come away pretty happy. I put a few more miles on my car nowadays. That's about the only complaint that I've got.
So let's go back to when you set up the multi-series LP at Western, before True North, and kind of what your goal was, what you were thinking, and how you were thinking about the strategies. And you had a real estate series and an oil and gas series. Kind of walk us through the sort of the evolution of that thinking, and then maybe just bring us all the way current to today.
Sure. So big picture, one of the first hurdles that I knew immediately we were going to have to get over is that the majority of good funds out there do not want to mess around with $500,000 or $1 million checks. And so meeting the minimums was an important consideration. And, you know, our client base at Western, which is not dissimilar to the True North client base, are wealthy individuals typically, but you've got to be, you know, quite wealthy to stroke a $5 or $10 million check into one line item.
Yep.
And so this is more, you know, the consideration was, okay, how do we amalgamate these assets? And this was initially with Western, not 100 clients, because we didn't have 100 clients, but more like 10, 15 clients, and then make a $5 million minimum with a hedge fund or a private equity fund, et cetera. And so that was kind of the first solve that we had to do was just being able to structurally, how do you even invest with this fund on behalf of all of our clients. And so that was one. Then, you know, I think the next major thing that we had to think about was, how do you bucket the individual assets and consider, a hedge fund is what's called an evergreen vehicle. It typically will, it's an entity, a limited partnership typically, that does not have an end date, and it strikes a NAV or net asset value on a monthly basis, and everybody gets a statement every month, and you hope that your number goes up and to the right over a long period of time. No distributions occur. And for you to get your money back, you have to redeem a portion or all of your capital. So, and those redemptions are typically quarterly. So that kind of a structure, we could have a bucket, for a quarterly redemption type evergreen vehicle. And that's appropriate for that type of an underlying investment, but it's not appropriate for me or us as a firm to make a 10-year commitment into a real estate private equity fund and then put that in a quarterly liquidity type of vehicle. And so then that was really the next solve, was thinking about, okay, when we want to start doing real estate private equity, we need to have a different series. This is a multi-series limited partnership, so that's part of the advantage of it. We can set up a new series. It's got different liquidity terms.
Yep.
It's got a different mandate, and then our clients, as an investment team, we can put together what the right asset allocation is and think about, let's say we want someone to have 5% of their investable assets in real estate private equity. Well, now it's easy to bucket those things. And so those were a couple of the initial considerations that we had, and that all went slowly. We wrote the first check in real estate private equity in May of 2012, and I didn't know that much about real estate investing at the time. And so again, it's then going and leaning on people who do know what they're talking about. Q had a real estate portfolio. One of the first things I did was go talk to the gentleman who ran that. His name's Tommy Ellis, and said, hey, I've got these couple of funds that we're looking at. I've done the underwriting I feel like I'm capable of. What am I missing? And then doing that with groups like Cook Children's Hospital System in Fort Worth, who had a great investment team at that time that we were really close with, and TCU endowment people or other institutional allocators that knew more than me.
Yep.
And frankly, as an investment team of two, what it was at Western at the time, that was what was necessary, I felt like, to build a really good portfolio of private investments, because I only knew so much. And so it's utilizing those relationships. We're in a different position today with an investment team of 6 of 5 of whom are over the age of 40 and pretty senior people. There's a lot more that we can leverage internally. But it wasn't always the case for me.
Yeah. One of the questions I have for you is, obviously, from the moment I met you and as I've listened, your ability to understand deals and source them is pretty impressive to me. I'd love to know, Chris, kind of a 1, 2, 3 what are your non-negotiables as you're assessing a real estate, a private investment? And I know they might be different, as they should be for each category, but kind of high level, what are a partner's got to have or better not have items as you evaluate deals?
It's tough because there's so many different asset classes. Those that might be a little bit different for a hedge fund versus a real estate operator, for instance. But alignment, I think, has to be, at least if not at the top of the list, in the top couple. We're looking for, I'm going to use the term operators or GPs, that anybody that we're investing in, regardless of asset class, we want to be aligned with them. And so an example of that is they need to have a lot of their own personal wealth in the same vehicles that we're investing in.
Yep.
And we don't want their particular, what you end up with a lot of cases in the private equity world with really large firms is everybody's getting rich on the management fee, and it doesn't really matter what their performance is. That's where you start to see, the alignment diverging to the point of where we're less comfortable. So I think that's certainly one of the big ones. After that, we're looking for groups that have some kind of an actual edge. I think as a general rule, the fee structures in alternative and private investments are high. Like it's expensive. There's a management fee that's probably higher than a mutual fund type management fee, and they're getting some kind of a carry on the back end or promote, as a percentage of the profits that they generate. And so we have a really high hurdle internally for, why are we going to make that investment with them? And so always trying to compare to whatever else is out there and figure out if we can find that operator that has an actual edge, and there's a reason why what they're going to do is going to outperform the generic market, or what term that we call beta, the beta of the market, then that's the sweet spot. And that's easier said than done, obviously. And depending on the asset class, there are certain asset classes like large cap stocks where it's very difficult, to find an edge. There's a lot of eyeballs on Apple stock and Coca-Cola and names like that. But if you go into certain, smaller niches like small bay or, class B industrial in Texas, it's a little easier to find operators that are really good at what they're doing versus the generic beta of the market. So that's the idea. But really, the alignment first, the edge second, and then there are a number of other things around the quality of the setup. Is it an institutional quality setup with real checks and balances? Yeah. I don't want to have to trust a GP or an operator to do the right thing. That's not my job, is to trust them. Our job is to make sure that from a documentation perspective, everything is set up appropriately, where the Madoff scenario is not an option. Whether they wanted to do something, or not. So
good documentation.
That's right. So let's go, let's back up for a second, and when you joined Western, how much, the $100 million or so that was there when you joined, how much of that was in private alternative type, what we would consider alternative investments, and how much of that was public market at the time?
On day one, it was 100%.
100%
liquid
private.
Public markets.
Oh, it was liquid public. That's kind
right.
of, yeah, that's what I thought. So 100% liquid public the day you joined, which was in 2010? 2011. Okay. So obviously having spent 8 years at Q, your orientation was everything but public markets, right? So you brought that sort of lens and that philosophy. Talk about your own personal views on private investments at that time, and kind of where the market was headed, even where the market sort of has evolved to for, the individual investor, the family office that, now private investing is very much on the top of everybody's mind, but, back in 2010, not as much, partly because it wasn't as easy to access it, but people just weren't thinking about it the way they are today. So kind of walk me through, arrived at Western, 100% public markets. I'd come from this place where there's a lot of private stuff. Starting out, what was your vision sort of going forward, and then maybe tie that into where we are today at a macro view?
Right. I actually, from an asset allocation perspective, was not a whole lot different in 2011, what I was thinking about versus what our client portfolios look like today. I mean, I certainly had a realization that even if private investments are the best thing ever and the return profile is better and risk, less risk, higher return, everything else, you can't lock up all your assets for 10 years, even if you're a pretty large kind of approaching family office type wealth. So what does that number need to look like? How much money needs to stay liquid, et cetera? Ironically, the market performance from 2000 to 2010, as is kind of well known, as the S&P was flat for 10 years. And so I was coming off of a 10-year flat S&P, and the hedge fund that I had worked for generated high teens returns over those 10 years, annualized. And so the world seemed a little easy, hey, we'll build a hedge fund portfolio and generate teens returns, and it doesn't matter what happens to the S&P. Irony being that the next 10 years in the S&P was actually very good. And so no hedge fund portfolio outperformed the S&P from 2010 to 2020. But the asset allocation, I think, ended up, being something along the lines of depending on the level of wealth, but for a family that had a significant amount of assets and could afford the illiquidity of, approaching, call it a quarter-ish of your assets in private type investments, some 20 to 30% on average, and then maybe a quarter in what I'll loosely just call alternative investments, but we use the term diversifiers at True North, but that could include hedge funds, but also, any number of other things, including, private credit and some other stuff like that.
So your vision back then was similar to where we've landed today. So talk about, in the beginning at Western, you had the real estate series, you had the oil and gas series, you had the hedge fund of funds, and then kind of fast forward to how we've evolved the platform today with really 4 solutions to sort of fit into a traditional 60-40 portfolio, kind of the why behind what we have today.
Right. We definitely didn't do everything perfectly. And so on the hedge fund side, the initial series that we set up in 2011, I called one of them equity and one of them credit. And so equity being mostly long, short equity managers that were stock picking. And on the credit side, what it sounds like, high yield, distressed, other kind of corporate credit focused managers. It became apparent over, the next few years that was a little bit limiting because not every fund that we might want to look at fits neatly in either the equity or the credit bucket. So one change that we made when we thought about how do we roll this out to the True North client base, post Jan 1 of 2019, when we did the merger, was putting together a portfolio that was really a best ideas combination of everything, in both of those, plus other things that didn't neatly fit in either box. And so that was what became what we call the multi-strategy series. And we launched that March 1st of 2019, shortly after Western and True North came together. And it is really exactly that, a best ideas amalgamation of some equity managers, some credit managers, and then some, that I would call other, that have a little bit of a different strategy. On the private side, similar. We started in 2012 at Western with a real estate private equity series. That is a closed-end private equity style vehicle. So we raised the money over the course of, call it, a year, and I'll use 10 million as a round number. Let's say we put $10 million worth of client money in one of those, and then we would allocate that money to real estate private equity operators. Real estate one, which was our first one, we made 3 allocations, and so call it $3 million a piece. And then over the course of time, those groups go buy real estate, they develop property, they sell it, they execute their strategy, they give us distributions. Those distributions flow straight back to investors. And then at the end of 10, 11 years or so, that vehicle wraps up and is fully distributed, and then it goes away. So we did that with real estate a number of times. I think we were through real estate 4 when the True North Western merger occurred. We had also done the same thing in energy, which is largely oil and gas focused energy. We had done 3 of those vehicles prior to the merger. And then the third vehicle that we had set up in 2018, we called it Private Opportunities. It was really venture capital. And so that was kind of the third asset class. So we had those 3, similar to the liquid hedge fund bucket. The specific nature of those 3 series was a bit limiting, because there were some things that we would see in traditional private equity maybe, or other areas that just didn't neatly fit in any of those buckets. And so what we set up on the True North side, which has really been a game changer structurally, is an annual vehicle that we just think of as the best ideas of that year in private investments. And we call it Global Private Strategies, or GPS for short. But GPS basically allows the investment team to have captive capital at any given time, starting on Jan 1 of a specific year. And then we can look at all of those asset classes. So real estate, energy, venture capital, just being 3 of many, funds or deals, and then it's a portfolio management, kind of portfolio construction exercise. How do you size individual investments? How many line items do you want in any given year? We've settled on around 10. This year, 2023, is GPS 5. So we're starting to show a real track record. The first 2 or 3 of them, you can see that it's going quite well. And we generally aren't going to have more than 25 or 30% exposure to any one given asset class. But the idea is that over a longer period of time, and we can see this with the first 5 series, there's just going to be a different opportunity set in any given year versus the last year. And we don't have a lot of credit investments or distressed investments in GPS to date, but we did have 2 of them in 2020, which was GPS 2. COVID happened. That cycle ended up being quite short, but at the time there were some interesting things to do. And so GPS 2 looks a lot different than GPS 1 looked, and then also how GPS 3 looked, because of how quickly that all went.
Trends change, things are different. Why is private, so many of our listeners and viewers, they own businesses, because we're True North, they might own an RIA. Why is private investment key? Why should people be considering that in their portfolios?
I think the simplest way to say it is that the return expectation is higher than in the public markets. And if you are locking up your capital for an extended period of time, you should be able to demand a higher rate of return on your capital versus putting your money in the S&P 500. And so to the extent that that's not the case, then I would, wonder why someone would want to do private investments. But generally it's some combination of the return and the risk. And so we're always thinking about risk versus return versus liquidity, and those 3 things and how that fits together. But big picture, very, I guess, what I'd say is just kind of a blanket statement would be that, we're looking for significantly higher returns in private investments versus, equities, for instance. And, everyone asks, well, what's the what does the return profile look like, or what are you trying to do? There's a range even within a GPS type vehicle, for instance, but what we would generally say in GPS, if you average it all out, we're kind of targeting a 15%-ish annual return and 2 times your money, net of fees. So, and if you can't, in general, if you can't generate double-digit, type returns in private investments, then it's probably not worth all the trouble,
the risk,
and locking up your money for a long period of time.
Absolutely.
So talk about 2022 and kind of, the market performance of 22 and having an alternative portfolio sort of laid in with a traditional 60-40 mix. What kind of different experience or outcome you might have had with your portfolio, compare the two, 60-40 public market stock bond versus, a blend of some public market equities, some public market fixed. I know you've done this analysis. So
2022 was a very tough year for 60-40. Equities were down 18-ish%, which is rough, but normally in a market when you see equities down significantly, fixed income holds in there okay. And it was just a very odd year where you had rates moving higher dramatically at the same time when equities were going down. And so the rate move had a big negative effect on the fixed income, market. And I think global ag, bond returns were down 12 or something like that. So a 60-40 was pretty ugly at down, 13, 14%. And bonds didn't offer the protection that they, theoretically are supposed to, or what we would, we would generally come to expect. So it really, if you just had a 60-40 portfolio, that's what you were looking at. And the alternative investments or private investments, you would hope really outperformed those markets. And what we saw on the private side is we had really good positive performance, in 2022. And then on the diversifiers side or in the hedge fund bucket, down low single digit type numbers, so down 3-ish type numbers. And if you put that all together, then what we would generally see is portfolios that were down, but down low single digits overall, including equities and fixed income and diversifiers and privates, and some that were, approaching flat in a year when you're looking at, significant down double digits kind of numbers. And there's a peace of mind that there's a benefit in terms of peace of mind there, but really another benefit there is that it allows us as portfolio managers to be able to play offense when there's big moves in the market. And when your whole portfolio is down and things are cheap out there, but everything's down, well, how can you make a move in that situation and take advantage of certain opportunities versus when you've got a portfolio that is truly more diversified than just, stocks versus bonds, and you have strength in one part and there's parts of the market that are now overtly cheap, then you can move pieces around and take advantage of that. And we haven't seen really since 2008 a lot of genuine distress, but maybe we're starting to see some of that now in certain asset classes. And so it's going to be an interesting, next couple of years, I think.
The other thing that I think people lose sight of sometimes is, just the compounding of your capital over time. And so, the idea that if you lose 10%, you got to make whatever the number is, the math, 12 or 13 to get back to even. If you lose 50%, you have to make 100% to get back to even because your capital has been impaired. If you can go through a market environment like we did in 2022 and be down, low single digits, then when the market does rebound, you're back to compounding capital and growing your capital base much quicker versus the person who's having to dig out of a big hole before they get back to even. If you look at 08, 09 as an example, if you just rode the market down, 50%, during that time frame, it was 4 or 5 years before you got back to even if you didn't add capital. But if you were able to, only maybe be down half that amount or a third of that amount, then you were back in the black, just a year and a half later. So, being able to preserve and protect capital on the downside is really important. And I think that's one of the reasons we're such advocates of the private investment platform and the solution that's there. So Chris, you've talked about diversifiers, you've talked about GPS, the private equity, touch on private credit, the income series, and then tail risk.
So I think this is consensus. I'm not saying anything that other people aren't saying, but I think the most interesting change we've seen over the last 15, 18 months in the market is where rates are. Combine that with what's happened in 2023, the poster child being Silicon Valley Bank, where you've now got the lenders in the market, which historically the banks are the biggest players in that space, that are now sidelined either because they have already a problematic loan book in commercial real estate, for instance. There's an article in the Wall Street Journal weekly about problems there, or regulators are just tapping them on the shoulder saying, hey, be careful, we want we want banks to be more conservative. And so there's a vacuum there, and there's not enough capital in the market to lend. So the capital is not exactly there, and rates on an absolute basis are a lot higher. And so theoretically, there's a nice opportunity set in private credit. What's interesting about that is that it's a whole nother niche market. There's a ton of money being raised by the mega private equity funds, and that's kind of another thing we can talk about in a bit maybe. But there are many regular types of businesses, whether it's a real estate developers that are looking for 10, 15, $20 million type loans, or operating businesses that are looking for those kinds of sizes of loans, where the big sources of capital, the huge mega private equity funds, the Fortresses of the world and Apollos and KKRs and those types of groups, they can't dip down there and do that kind of thing. And so it's finding, the right operators out there that are operating in, we would generally say, the lower middle market. That's applicable to private equity. You hear that term a lot, but we use that term for real estate and private credit and other areas as well. And I would say, just to put some numbers on it, loans that might have been at 7, 8, 9% in 2021 that are now at 14, 15, 16% in 2023, and similar risk profile in some cases. So that we started to recognize at the beginning of 2022 what was happening, and that was changing. We launched a dedicated private credit sleeve in early 2022, and that's now got 9 or 10 line items in it. Not all direct lending, but there is a little bit of that. There is a little bit of real estate lending. There is some asset-backed lending and niche, assets like construction equipment, yellow iron type stuff, or container ships, or other things, and some consumer credit lending, and so similar to the multi-strat series, where we're trying to put together a number of line items that hopefully don't correlate exactly with each other and are all taking advantage of some opportunity. But the general idea being that it looks to us today like double-digit net yields are achievable potentially in a strategy where you're not necessarily taking as much risk, even as for instance just going and buying high yield bonds. And the high yield bond market, by definition, nobody likes to call them junk bonds, but the reason it was termed junk bonds is because these are over levered companies. And so in the private lending space, if you're in the right spots, you can lend to companies that aren't particularly over-levered. It's not liquid. You can't go sell that bond or that loan on the market necessarily tomorrow, But if you can give up a little bit of liquidity, your risk return profile actually looks really good right now in that area. So that's the income series that we've done I'd say a lot of work on over the last 18 months. And that's probably the biggest change, what the world looks like in the fall of 2023 versus what it looked like 2 years ago. Mm-hmm. The tail risk vehicle is an interesting strategy in that we did not have this in our portfolio until the end of 2021, and there's a group out of Miami called Universa that manages this strategy for us, and it's in very simple terms buying way out of the money puts on the S&P 500. And so it sounds, I could do that in my E-Trade account. Well, this particular group trades more options than just about any institutional investor out there, and it's actually very difficult to execute this strategy in an efficient way. The options market is notoriously opaque, and retail investors tend to not do very well, in the options market. But this group has a long-term track record going back well pre-2008. There's a number of institutional investors that are invested with them. The minimums are extremely high. I think they have 35 or so LPs and 9-figure minimums to invest with them. And it was really a function when we started looking closely at this, initially was interest rates are very low. We're not getting rewarded for investing in fixed income. So how can you have a portfolio that's going to do better than fixed income, but without taking an inordinate amount of risk? Because you could take a 60-40 portfolio and just make it an 80-20 portfolio, but that's a lot riskier. And so what we did in late 2021, we started investing in Universa and effectively protecting our backside. And if equity markets draw down significantly, that's going to be a highly profitable strategy. And in the meantime, you're paying a little bit of option premium over time. And so it's the opposite of picking up pennies in front of the train. And so, or the inverse of that. And so that is a strategy that, we began to employ in late 21. Like I said, when we felt like equity markets were pretty rich, but fixed income markets weren't giving us, a lot of juice. But it has become clear that as long as equities are valued, at or above historical levels, we love that position. And that, one of the interesting things, if you play this out, if there is another real equity crash, I mean, the last time this happened was in 2020. That didn't last very long, but that was an extremely profitable strategy during COVID. But if you go back to like a 2008 type scenario, kind of what I mentioned before is having dry powder at the right time is important. And something like the tail risk strategy is the exact scenario that you want, because theoretically, if there's a 25 or a 30 or a 35% drawdown in equities that happens over a relatively short period of time, something drastically has gone wrong in the world. And when that occurs, dislocations happen right and left, and there is always something to do. And it may not be just dumping money right into equities at that time, or it might be. But what happens with the tail risk strategy is it is paying out exactly at the time when the market, is crashing in that way, which would give us as a firm, but really our clients, the flexibility to then be taking advantage of that. And because, riding the market down and back up is one thing, but to your point before, riding the market down and then adding capital at a low point, you come back much quicker. And so that has become an integral part of the portfolio on the alternative side. And so combining all of those four things, the multi-strategy vehicle, which we call diversifiers, and the private side with GPS, the tail risk side, and the income vehicle, along with liquid equities and fixed income, starts to look like real diversification. And as opposed to, thinking to yourself that diversification is, having large and small caps or maybe some international stocks, et cetera. So that's what the portfolios typically, will look like.
And one of the things I love about what our investment team has done, and what Chris and Drew have really worked on, is that those 4 solutions that we just went through are really that. They are solutions to this answer of, gosh, if I'm just typical 60-40 public market, stock bond, kind of the traditional way of that people have always done things. What can I do to be very complementary of that? And in contrast, much of the industry is sort of like, okay, what is marketable? What will sell? What will people buy? What's easy for me to package and replicate and distribute, in a large way? You mentioned some of these larger funds a second ago. We'll come back to that in just a second. But we've really built these 4 solutions to be complementary, not to go market them as a product company would. And so, I love that about the way these guys have been super thoughtful about the process. And then the other thing is we don't have economics on those vehicles when our wealth clients are invested there. So we're not double dipping, getting a second fee, whatever, which is also somewhat unique.
Yeah, which brings me back to one of Chris's first points about was alignment. I think one of the things, Chris, as we start to kind of wrap things up in today's conversation, the thought that just keeps coming to my mind to so many business owners: what are the questions a business owner, most of their wealth is tied up into their business at the moment, but what are some pragmatic things a business owner, in your experience, you've been the investor, you've seen hundreds if not thousands of deals. I loved the comments around alignment and edge inside, but what are the things they need to be doing today to find not just a wealth management, but just an alignment? What would you coach them as they manage their business, knowing one day there's going to be an exit? What are things they should be doing today? What are the ducks they need to be getting in a row? So whether they were going to sell in 6 months or in 6 years, from your perspective, I'm a business owner. I have a business. We gross 20 million. Our EBITDA is about 18%. You know the profile. What should I be doing today to build my business for a solid, really holistically positive exit?
Certainly before someone goes out and puts anything in writing about their intention to sell a business, there are some real planning related steps that can be taken that could save enormous amounts of tax for that person. And so talking to someone that knows what they're doing around pre-transaction planning is item number 1. Item number 2, I would say, is having the right partner that can help somebody sell that business. And I mean, that's the generic term is investment bank, but thinking about what does my exit look like, and am I talking with the right person who is going to be able to open up all the correct doors? And there are strategic exits, and you can sell to financial buyers, and those two things look very different in terms of both, what your day looks like, the 30 days after you close, day 2 after you close a deal, but also years down the road, and what the legacy, is like for your company, and all kinds of things. So I think those two things
super
on
helpful.
The planning side is what I would say. And then on the, potentially partnering with an advisor to manage wealth and quarterback other things for you down the road. I think talking to multiple people is helpful. There are very different paths that can be taken. Where I'm, of course, a little bit biased. I think the independent advisor that has no products to sell, that is not being told by somebody in New York, this is what we're going to sell, go ahead and push it. Like I think that's the the right
proper alignment,
the right way to go. Right, there's alignment, but that's not just any independent advisor. There are just because I'm not getting pushed products from New York doesn't mean we know what we're doing. And so I think the finding of the firm that's the right size, has expertise in clients that look and feel a little bit like you, is important. I wouldn't want to be someone's largest client, and I certainly wouldn't want to be someone's smallest client. And then I think there's a philosophy internally about if we're just talking about the investment side, risk and reward and asset allocation and all of that, and you tend to see in the pension world, for instance, that pensions have a bad reputation of investing in the quote unquote safest, managers or big blue chip private equity funds, because the guy at the pension or lady at the pension doesn't want to get fired, and so that's a safe investment. Yeah. And so what you end up in with in that point is you get beta in private equity when you're investing in a $10 billion type fund. And so finding a group that can hit that sweet spot of actually sourcing unique, interesting ideas, but not taking you out on the risk curve, in a way that 5 years down the road, you're going to look at a portfolio and say, well, what went wrong here? And there's some art and there's some science to that.
100%. What do you have, any final things for Chris?
No, I think we've covered it. We've done a good job.
What there's so much to it. Thank you for investing time with us, understanding private and diversification, the thoughtfulness of the process. Chris, thank you very much. Thank you for joining us on Decision Points.